A very good morning, everyone, and thank you for joining. My name is Rona Biju, and I'll be your host for today's webinar on the topic Understand VAT, Excise, and Corporate Tax in Free Zones and Designated Zones in the UAE. Before we dive right into the webinar, I would like to give a brief introduction about our company. ITC Accounting and Tax Consultancy is one of the top and most reliable tax agency firms in the UAE. In a short span of time, our team mastered how to give clients the best tax solutions. You can expect an uncompromised attitude when it comes to quality and professionalism. We deliver a sleek and professional outcome that sets us apart from the competition. With the leadership of Mr. Ahmed Sharfuddin, we've already positioned ourselves as the VAT and excise tax specialist in the market. We have a fast growing team of qualified and dedicated professionals with innovative and commercial approaches to meet today's highly challenging business environment. By bringing the best team at your service, highly experienced tax and finance specialists in the industry, ITC will continue to create long-term relationships with various businesses by having the ability to deliver as exceptional service that is satisfactory on all levels of quality and speed. As a testimony to our strategic and proven approach, most of the customers we serve are generated through referrals and repeated businesses. Moving on, I would like to give a brief introduction about our panelists for today's webinar. Mr. Josefa Abu Heba. Mr. Josefa Abu Heba, a seasoned senior tax manager and FTA-approved tax agent in the UAE with a remarkable 10-year record in accounting and taxation. He brings a wealth of expertise to various business sectors. His specialization lies in handling indirect taxes, including VAT and excise, while showcasing proficiency to streamline financial operations. Driven by a self-motivated and ambitious nature, Josefa's dedication ensures seamless task delivery even in challenging situations, making him a reliable and efficient professional in his field. As a senior tax manager at ITC Dubai, Josefa plays a strategic role offering valuable tax advice and ensuring strict compliance with tax regulations for clients. His standing as an FTA registered tax agent adds further credibility to his services. Josefa has continuously honed his abilities to deliver exceptional performance and solutions to the continent. Now, I would like to hand over to Mr. Josefa to start off with the webinar.
Thank you, Rona, for the nice presentation, and thank you everyone for joining us in today's webinar. So as we mentioned earlier, today's it's about free zone and designated zones. We are talking about corporate tax, VAT, and excise tax as well. I will be going through VAT and excise tax, and after that, my colleague will be talking about corporate tax. So now we are going to start with VAT in designated zones. So in general, for free zones, actually in the UAE historical context, free zones have usually been exempting from its territorial jurisdiction. As we know, like free zones having its own law and applicable rules. So, however, this exclusion doesn't automatically apply to VAT regulations. Specific free zones listed in a cabinet decision are eligible for distinctive VAT treatment subject to limitation. So as we start with the title, we said VAT in designated zones and didn't say VAT in free zones. This is the reason because actually not all free zones are designated zones, but definitely all designated zones are free zones. Here in second point, as I said, we mentioned that these nominated zones, termed designated zones for VAT, are required to adhere to strict control standards and implement security and customs protocols, and are considered outside UAE territory for VAT regarding certain goods supplies. So as I mentioned, not which this is the misunderstanding in the market. Some taxpayers, they consider any free zones is having some special rules regarding VAT, which is wrong. Only the designated zones. And here we are talking about the Article 51 in Executive Regulation, which give the exception and the special rule regarding designated zone. And almost in UAE, we have around like 27 designated zones, and all listed in the decision. So this implies that many goods supplies within designated zones fall beyond UAE VAT scope, and definitely this will be based on some criteria, including record keeping and the different. We need to differentiate between the supply of goods and supply of service. And definitely, we will be going for the next slide to talk more about supply of goods in designated zone and supply of service. So we will be starting with the supply of service in designated zone. So regarding service provision, if according to standard regulations, a designated zone would be the usual place of supply, and this holds true for service provided within the UAE. Consequently, services rendered within designated zones are subject to UAE taxation. So this means the service, when it's supplied in the free zone, it has a place of supply within UAE. That's why the tax, the VAT, will be applied there. So this implies that the majority of service will attract standard rated VAT, similar to if they were conducted within the UAE. Similarly, service exported to outside UAE, it can be zero rate. So here we are talking about the supply of service. And also this we have seen in the market, like many taxpayers also, again, they think that supply of service within designated zone, it has a special treatment, which is not there. So the supply of service within designated zone still subject to VAT, same as any area in UAE mainland. Okay, so now in this slide, we are going to talk about the supply of goods. We have covered the supply of service in the previous slide, and now it's the supply of goods. So goods supplied within designated zone are treated as offshore for UAE, but if specific conditions are met as stated in Article 51 of the Executive Regulation, normally such supplies aren't subject to VAT. However, if goods are supplied within a designated zone for consumption, within the zone, standard rated VAT will be applied, but exception from this if it was for the purpose of resale and it will be exported or imported to UAE mainland. So in this point, I would like to elaborate more. So here's the supply of goods as per Article 51 of the Executive Regulation regarding designated zone. So the supply of goods between designated zones, it will be out of scope with a condition that the goods will not be consumed on the way, like between the post designated zones, as well as the supply of goods within designated zone. It will be out of scope, but subject to the condition that this sale is for the purpose of resale and not for the consumption. And also the other condition, it can be the sale within designated zone for the purpose that these goods will be incorporated to another goods, and these other goods will be for the purpose of resale and not for consumption. This means the supply of goods within designated zone is out of scope with a condition that these goods are for the purpose of resale or it will be incorporated to other goods for the purpose of resale. So here, if the supply of goods within designated zone is for consumption reason, so this will be taxable 5%. Which also I would like to highlight this point because also there is a practice in the market, like companies, they treat any supply of goods within designated zone as out of scope without keeping the documentation which prove that this supply of goods was for the purpose of resale or was for the purpose of using these goods to be incorporated to another goods. So taxpayers mostly they have to keep the documents which prove the tax treatment for the supply of goods they are making. So in this case, usually we are asking taxpayers to take a declaration letter from their customer stating that these goods are for the purpose of resale and not for the purpose of consumption. And at the same time, also in Article 51, the sale of goods also can be out of scope in case the goods was sold to outside UAE and the supplier having the proof that the goods was exit the country, and also it's out of scope if the goods was imported into UAE and the supplier having the proof that the goods was imported and that was paid while importing the goods. So in those cases only the supply of goods can be considered as out of scope. Other than this, if the supply of goods for consumption or the supply of goods for other reasons and you don't have the documents to prove the taxability for this treatment, then you should make it as a 5%. So as of now, we have covered the supply of goods and supply of service in designated zone, in VAT designated zone. And we are moving now to discuss some special cases for the supply of goods or service within designated zone. So first special case we have here, it's the supply of water and energy. So water and energy supply is considered as goods, and it can fall outside UAE VAT if they meet set conditions within designated zones. Yet, if provided for consumption, like by utility authorities like DEWA in Dubai, they are subject to regular VAT in UAE. This override applies even if used in producing other goods within the zone. The term energy encompasses various forms. Notably, oil and gas trades within designated zone can be out of scope if criteria are met. So here, this special rule is about the supply of water and energy. Supply of water and energy is subject to 5% as it's a supply of good, and it's consumed within the designated zone. So it will be subject to 5% VAT. Supply of energy like oil and gas, it can be out of scope. It's for the purpose of resale. So in this case, it will be out of scope, but any supply of water or energy within the designated zone is taxable with 5% VAT. Now moving to the second case, which is about the supply of real estate. As we know, the real estate supplies, either sales or leases, are categorized as supply of goods, with their supply location determined by the real estate location. Selling or leasing real estate within a designated zone doesn't constitute consumption. Thus, it will remain as out of VAT scope. So the supply of real estate, either sale or lease within that designated zone, it should be out of scope. And this also applies to the raw material bought within a designated zone for constructing real estate, intended for use in the production of unconsumed real estate. However, service linked to real estate, apart from sales or leases, fall under VAT even within designated zone due to the service supply rule. So here we are saying that the supply of real estate, either sale or leases within designated zone, it should be out of scope. Any service related to the real estate, apart from sales or leases, it should be supply of service, and it should be subject to normal tax rules. It should be 5%. So now moving to the next slide, which is the third, let's say the third special case about designated zones, which is about tax group. Many taxpayers are asking about tax group regarding their branches, which is in designated zone, or regarding the sister companies, which is in designated zone, and they want to form a tax group. So here in this slide, we are going to cover this point. So regarding tax grouping, a business within a designated zone still treated as a UAE entity can okay. So in next slide, we are going to talk about the third special rule about designated zones, which is about tax grouping. Many taxpayers are asking, we have a sister company in designated zone, or we have a branch in designated zone. What could be the tax treatment? Can we form a tax group in cases of sister companies, or what we can do? So in this slide, we are going to cover this topic. So regarding tax grouping, a business within designated zone still treated as a UAE entity. It can create a tax group within an onshore or another designated zone company following regular control criteria. So this means if your company is established in designated zone, you can form a tax group with another company established in designated zone, or you can form a tax group with another company which is in mainland. Definitely, this all will be subject to tax grouping criteria. In second point here, we are discussing that like the standard outcomes of tax grouping apply, like ignoring supplies between members for VAT and shared liability. However, transferring goods from a designated zone to the UAE mainland within the tax group will result to import VAT payable through standard procedures. This import VAT can be deferred by VAT registered tax group in its VAT return. And this point sometimes create a confusion to taxpayers because they are saying we are a tax group. I have my company in mainland. I have my company in designated zone. Why, when I do import, I have to pay VAT? So in this case, because in this time when you are making import, you are making import as one entity, as a tax group. You are moving goods either from outside UAE or from the designated zone to the mainland. So in this case, it's not about you are making a supply between your tax group company. You are making a supply as a one entity importing goods to UAE mainland. That's why tax will be applied. Definitely, if your custom code is not linked with your TRN, you have to pay the VAT to clear your goods. But in case your custom code is linked with your TRN, so this VAT liability will be deferred until your VAT return, and it will be coming in box number 6 as import of goods, and you can make reverse charge mechanism in box number 10. So in the next slide, we are going to talk about like the fourth special case regarding designated zone. It's about branches for a single entity. So entities with branches in both designated zones and the UAE mainland can have inter-entity supplies like between head office and the branch, and this should be disregarded for VAT purposes. Also, moving goods from a designated zone to the mainland could trigger import VAT obligations deferrable for VAT registered entities in their VAT return, and unregistered entity must pay import VAT before releasing goods from the designated zone. So also this same criteria applied for the tax group, as I mentioned. So the transaction between the tax group entities or between the head office and its branch, it should be ignored for VAT purposes. However, if you are going to make import of goods to the mainland, so this will trigger VAT for import, and it should be paid if you are not registered or if you didn't link your custom code with your TRN, and it will be deferred with the VAT return in case of. As of now, we covered those special cases regarding designated zone. Now we are moving to the last special case, which is also creating some confusion for taxpayers, which is about VAT recovery. So can business who are operating in designated zone recover VAT? And regarding this point, in designated zones, businesses follow regular VAT rules for expense recovery. Only recover VAT on expenses if supplies are VAT liable. Unable to recover VAT on expenses tied to non-recoverable supplies. Apportion VAT for expenses relevant to both recoverable and non-recoverable supplies. VAT recovery requires VAT registration with the FTA. So I would like to elaborate more about VAT recovery for businesses who are operating in the designated zone. So first of all, to be able to recover your VAT, the VAT you are paying for your expenses or purchases, you have first definitely to register for VAT and to have TRN. And after that, you can do your VAT return and submit refund request. Now, the question is, are you eligible to do this VAT refund or not eligible? So definitely, if you are making taxable supplies or if you are making out of scope supplies, it would be taxable if it was supplied within UAE. So in this case, you will be eligible for the VAT claim and refund. But in case you are making exempted supplies, so in this case, you are not allowed to claim. In the cases that you are making mixed supply, like some of it taxable or some of it exempted, so you have to do apportionment. And as FTA, as per law and FTA regulations, the apportionment it will be based on the standard method, unless you want to use a special method, and definitely you have to get special approval from FTA to use it. So in general, businesses who are operating in designated zone, they are allowed to do VAT recovery for the VAT input. But as I said, it depends on the supplies you are making. You should be making taxable supplies to be allowed to the recovery of VAT. And in case your supply is out of scope, so you should have recovery for the VAT in case of the supplies you are making. definitely it's out of scope, but it would be taxable if it was made within the UAE. So by ending this slide, we have covered some main topics regarding VAT designated zones. And now we are going to move about excise tax designated zones. So again, there is some assumption in the market between taxpayers that like excise tax, it has special rules also in that designated zones or in free zones, which this is like is not correct assumption or correct understanding. So as we said, like not all free zones they have any exceptions regarding VAT. Only that designated zone it has the exception. Also, when it comes to excise tax, all UAE, including the free zones and the VAT designated zones, are considered as mainland for excise tax, and excise tax is due and it should be paid. And only the exception here is happening about excise tax designated zone. So now the question, what is excise tax designated zones? So excise tax designated zone is a specific area or location within UAE. So definitely it can be in mainland, it can be in free zone or VAT designated zone. Has been officially designated and approved by UAE Federal Tax Authority for the storage and handling of excise goods. And definitely it should be handled by a warehouse keeper approved by Federal Tax Authority. Excise goods are those that are subject to excise tax, definitely such as like tobacco and tobacco product, carbonated drinks, energy drinks, and also sweetened drinks, and also electronic smoking devices. So now we are talking about excise designated zone. So it should be some specific area or location. It should be approved by Federal Tax Authority. It should have a warehouse keeper to manage this area. Only this area will be having the special rule regarding excise tax. Out of this designated zone, there is no special rule and excise tax is due. So now again, let me remind you that when excise tax is due, excise tax is due when you are doing import of excisable goods, when you are doing production, I mean producing excisable goods, and when you are releasing excisable goods from the excise designated zone. So in case the goods is kept within the designated zone, then you are not liable to pay the excise tax unless you consume it without the designated zone or you release it from the designated zones. So mainly here, excise designated zone is helping companies who are dealing in excisable goods to manage their cash flow, because you can imagine if you are doing import of large quantity of excisable goods, you will be required to pay the excise tax when you import it, unless you enter into a designated zone. And in this case, you will not pay the excise tax unless you release it from the designated zone. So now some of you will be asking like, what is the requirements? How we can set our designated zone? So now in the next slide, we are going to discuss what is the requirement to set up and to register excise tax designated zone. So as part of the registered zone, as part of the designated zone registration or renewal of registration request, the warehouse keeper is required to first thing, like you need to specify the type of excise goods that you are or will be kept in your designated zone. As I said, there is different excise goods. So you need to specify in your request which excise goods you are going to deal with. Secondly, you need to specify the quantity of excise goods which is or will be kept in your designated zone. Also, you need to provide a financial guarantee in respect of the excise goods you are going to keep in your designated zone. Also, you need to provide a proof that adequate physical security measures in respect of the designated zone were implemented. And actually, this is one of the main points or main parameters that Federal Tax Authority they are reviewing before they approve your designated zone, which is the physical security. And also, you need to prove that you maintain a stock and record management system which track your goods. Also, this is one of the main parameters. So, as we said now, security, physical security, you need, make sure it's there, and also the system for stock and record management, moving into and out of the designated zone, as well as transfer between designated zone. So you should also have the measures which you control the movement of goods from or to your designated zone. So mainly this is the requirements for registering a designated zones. And let me here elaborate more about the security measures. Mainly, Federal Tax Authority is requesting that the place, it should be closed. And in case, for example, you have window, it should be like some metal bars there. And you should have some control to access the movement from inside to outside or outside to inside. Also, you should have like CCTV to monitor the place. Mainly, this is the parameters required for the physical security. Now we are moving to talk about the quantity of excise goods in designated zones. So now we'll discuss 2 points. One is, if in case you are in the business and you are dealing with excise goods and you would like to register a designated zone. Other case we have here, if you are new in the business and you would like to register a designated zone for excise goods. So here, at the time of registration of a designated zone, the applicant must provide the FTA with average months in stock of the relevant excise goods that will be in designated zone over a 12-month period based on the following. So here, in the first case here, we are discussing that if you're already in the business of excise goods and you would like to register. So if the applicant is already in business and has a warehouse in which excise goods are stored, the applicant is required to determine the average months in the stock of the relevant excise goods based on actual months in the stock of each product of excise goods held in the last 12 months preceding the date of application. So this will be applicable for the companies who are already in business with and dealing with excise goods. Second is, if the applicant is planning to start operating or managing a warehouse and doesn't have the quantities data to determine the actual month in stock, the applicant is required to forecast the expected months in stock per product of excise goods to be held for each of the coming 12 months. So definitely, if you are new in this business to deal with excise goods, you will not be having a record of last 12 months of these goods. So if they allow here, you submit the forecast of the coming 12 months of the goods you are going to deal with. Here also, there is one important point, and it was published recently from FTA in the last public clarification regarding designated zones, which about following the approval of the application to register or renew a designated zone, the warehouse keeper must monitor the average months in the stock of excise goods stored in the designated zone for 6 months, following such as registration and renewal average month in stock. So mainly here, Federal Tax Authority set the criteria that after your designated zone registration or renewal, you need to monitor your months in the stock for the coming 6 months, and you see if the average of this is exceeding 20% of what you submitted to Federal Tax Authority, you have to notify FTA. Definitely, if it's not exceeding, so you can continue. So the warehouse keeper is required to notify the Federal Tax Authority if the average month in the stock over the 6 months period increased by more than 20% of the originally reported quantity of excise goods in the designated zone at the time of registration or renewal. So in this slide, we have covered what is the requirements to register for designated zone. In the previous slide, we have discussed what is the requirements regarding how you need to specify the area and the goods you are going to deal with, the financial guarantee, the physical security, and also the record and stock management system and CCTV and this all. And in this slide, we have discussed regarding the stock. In case you were in the business, you are required to submit your last 12 months stock record. And if you are new in the business, so you can submit to FTA as expected stock. And after registration or renewal for your designated zone, you have to monitor your stock for 6 months and see if the closing stock is exceeding 20% more than what you submitted to FTA while the registration or renewal. And if it's exceeded this, you have to notify them. Now moving to the next slide. So mainly here next, we are talking about the physical security. So here we are discussing like what could be the elements that Federal Tax Authority is looking into when they review the physical security in designated zone. So the physical site has sufficient space to store at least the average months in the holding stock reflected in the registration report. So it doesn't make sense you are like you want to register a small space, but same time the average stock for 12 months you are giving to FTA is huge or vice versa. So the space should be matching with the stock you are intended to keep in your designated zone. Second point is the premises allow for excise goods to be stored in separate identifiable locations that are clearly marked. Third point is about the entrance and the external doors of the premises are of solid material and fitted with appropriate locking system such as keypad code locks or electronic locks. If separate freight doors are constructed, all access through the freight doors are monitored with CCTV camera and or security personnel. Windows are fitted with barriers to restrict access and removal of excise goods. And alarms or anti-theft or anti-intrusion system are configured to detect unauthorized access outside business hour. These systems are connected to a security monitoring point, such as security office on the site. So these mainly the main parameters or the main elements that Federal Tax Authority are looking into when they assess your security, your physical security measures in your excise designated zones. So now we are moving to the point regarding the stock and record management system. This is also one of the main elements that Federal Tax Authority are looking into for your excise designated zones. And so for the stock and record management system, the warehouse keeper must implement a stock and record management system, ideally an accounting and inventory management system that provides a clear audit trail of all excise goods entering and exiting the designated zone or area intended to be registered as designated zone. And the system must be sufficient to identify the following. So first, stock levels, the stock levels in designated zone at any given time. So the system you are going to use in your designated zone, it should be allowing you to check your stock levels at any moment. Also the value and quantity entering, the value and quantity of excise goods entering the designated zone. Also the value and quantity of excise goods leaving the designated zone or consumed within the designated zone. Additionally, the value quantity transferred to designated zone, the value and quantity of excess goods which transferred to another designated zone, including details of that designated zone, and also value quantity for export and the value and the quantity of produce in case you are doing production within your designated zone. So here we have discussed the stock and record management system. And by reaching here, this will be the end of my presentation. We have discussed regarding VAT in that designated zone, and also we have covered excise tax within excise tax designated zone. And now we'll be moving to discuss about corporate tax in designated zone. I would like to thank you again for attending this webinar, and let's move ahead. Thank you.
Thank you, and a big round of virtual applause for Mr. Josefa for sharing the expertise and insights with us today. Your valuable contribution has truly enriched our understanding of excise and VAT on the topics free zone and designated zones in UAE. Now, let's hand over the virtual podium to our next speaker, Mr. Duresh, who will delve deeper covering CT on the free zone and designated zone in UAE. Mr. Duresh is a seasoned tax professional with over 8 years of experience in taxation and finance. Duresh Kumar is a proficient corporate tax expert He holds the designation of ACCA and possesses extensive knowledge of corporate tax laws both in Pakistan and the Middle East. Throughout his career, Duresh has worked for reputed corporations such as the Big Four consultancies. Duresh's expertise encompasses direct taxation, indirect taxation, international taxation, and transfer pricing. His guidance aids clients in understanding tax implications and optimizing tax efficiency. Duresh's dedication to clients is evident in his commitment to compliance with tax laws. He excels in sharing tax compliance knowledge backed by a profound grasp of financial systems. Clients trust him as a reliable advisor due to his technical prowess and business acumen, solidifying his position as a respected corporate tax professional. Now, I would like to hand over to Mr. Duresh to start off with the corporate tax.
Thank you, Rana, for introducing me. Now we'll be discussing about the corporate tax and its implications in the free zones and designated zones in the UAE. So there have been two decisions about the free zone recently. The first one is the Cabinet of Ministers issued decision, that is number 55 of 2023, effective from 1st June 2023. It determines the qualification, what is the qualifying income for the qualifying free zone persons under the Federal Decree Law number 47 of 2022. The second decision is by the Ministry of Finance, which discusses the terms qualifying activities and excluded activities. It's decision number 139 of 2023. Now the question is, who will be the qualifying free zone person under the corporate income tax law? So under Article 18 of the city law, a qualifying free zone person is person which meets the following conditions. So the conditions are: maintains adequate substance in the UAE, drives qualifying income, has not specifically elected to be subject to corporate tax under the law, complies with transfer pricing regulations, maintains audited financial statements as per IFRS or IFRS for SMEs, and which meets the de minimis conditions. We will be discussing these conditions one by one in the next slides. So the question is, what will happen if these conditions are not met? So if the conditions are not met in any tax period, the qualifying free zone person will lose the status of the current and following 4 tax periods. This means that the individual will be subject to a 9% corporate income tax for a duration of at least 5 years, being treated as taxable person. Another thing is, what is adequate substance by a free zone person? So the decision issued by cabinet that clarifies what is the adequate substance. So it is a qualifying free zone person which undertakes its core income generating activities in the free zone, has adequate assets and adequate number of qualified employees, incurs adequate amount of operating expenditure having regard to the level of activities in the free zone. So if these conditions are met, then it means it's adequate, they have adequate substance therein. In the next slide, we'll be discussing what are the incomes which are excluded and what are the incomes which are included to qualify and to categorize the qualifying income. So the incomes which are excluded, these are income attributable to domestic PE, incomes attributable to the ownership or exploitation of immovable property, incomes derived from any person specified in the excluded activities, and incomes derived from a non-free zone person other than qualifying activities. Now, following are the incomes which are included. These are any income derived from other than free zone persons, provided that the free zone person is the beneficial recipient of the relevant services or goods. Income derived from the qualifying activities undertaken with a non-free zone person. These even include any incidental income derived therefrom, and any other income subject to satisfaction of de minimis requirements. So we'll be discussing about these points in the next slides. Number one, domestic permanent establishment. So a domestic PE has been defined to mean a place of business or other form of presence of a qualifying free zone person outside the free zones in the UAE. So within UAE and outside those qualifying free zone person, if there is any place of business, that will be called a domestic PE. Number two, income attributable to a domestic PE or foreign PE. So if there is any income related to domestic PE or foreign PE, that will also be considered as taxable income, chargeable to corporate tax at 9%. Three, income attributable to immovable property located in a free zone. So there's any income from immovable property that will also be subject to 9%. And those transactions shall be with the non-free zone person in respect of commercial property, and transaction with any person in respect of immovable property which is not a commercial property. Now, the commercial property is also defined as the property which is used exclusively for a business or business activity and not used as a place of residence or accommodation, including hotels, motels, bed and breakfast establishments, and service apartments, and the likes. Number four, excluded activities. So the following are the excluded activities: transaction with the natural persons, banking, finance, leasing, and insurance activities subject to regulatory oversight, ownership or exploitation of immovable property except for transaction with free zone person in relation to commercial property located in a free zone, ownership or exploitation of intellectual property assets, and any ancillary activities in relation to the above activities. Number five, qualifying activities. Following are the qualifying activities: manufacturing and processing of goods or materials, holding of shares and other securities, ownership and operation of ships, reinsurance and fund and wealth and investment management subject to regulatory oversight, headquarter treasury and financing services to related parties, financing and leasing of aircraft, logistics, and the distribution of goods in or from a designated zone subject to certain conditions. In the next slide, we'll be discussing the last one, which is non-qualifying revenue and total revenue. So, the revenue derived by a free zone person from any of the following activities in a tax period would qualify as non-qualifying revenue, which is excluded activities and any activities that are non-qualifying activities where the other party to the transaction is a non-free zone person. So, if there is any revenue from these activities, it will be non-qualifying. Total revenue is all the revenue derived by a qualifying free zone person in a tax period, which is revenue attributable to a domestic PE or foreign PE, revenue attributable to immovable property located in a free zone. So all the revenue will be called total revenue. So just to conclude, now what is the assets within a free zone? So this is any free zone individual person with preserves sufficient assets within the free zone adheres to Article 34, that is arm's length principle, and 55 transfer pricing documentation, drives qualifying income according to cabinet issued decision, has chosen not to come under the purview of corporate tax, the revenue falling below de minimis requirements is not considered qualifying, and it compiles reviewed financial records for auditing purposes. So if these conditions are met, then there will be 0% corporate tax. And now the question is, what will happen if these conditions are not met? If these conditions are not met, the qualifying free zone person will become at the start of the relevant tax period and the next 4-period tax period eligible. Now we'll discuss about the de minimis requirements, which is a non-qualifying revenue during a tax period shall be less than or equal to 5% of revenue that is total revenue, or 85 million dirhams. Whichever is lesser, that means it is de minimis requirement is are being matched. So in the next slide, we'll see the calculation of the de minimis requirements. We'll contrast the non-qualifying revenue with the total revenue in order to calculate the de minimis income. A non-qualifying revenue comprises the following: revenue from excluded activities, and number two, the revenue from non-qualifying activities when other party to the transaction is a non-free zone person. And the total revenue is defined as all revenue generated by a qualifying free zone person during a tax period. So in order to calculate de minimis requirement, we'll contrast non-qualifying revenue and total revenue, and will not consider the following: revenue from immovable property located in a free zone derived from number one, commercial property transactions with non-free zone persons. Number two, dealings with any person involving immovable property other than commercial property. Will also not consider revenue attributable to the non-qualifying free zone person's domestic PE or foreign PE. Now in the next slide, we'll summarize where there will be 0% income and where it will be 9% income. So there will be 0% corporate tax if the income source is from exchanges with other residents of the free zone, qualifying activities traded with non-free zone persons, and any other earnings. There will be a corporate tax rate of 9% if the income source is from earnings from excluded activities, income attributable to a domestic foreign private equity firm, and revenue from the ownership or exploitation of a real estate. In the next slide, we'll be discussing about the qualifying activities which are mentioned in the ministerial decision number 139 of 2023. Following are the activities which are qualifying for the purpose of calculating the corporate tax rate. The production of products or materials, the processing of products or materials, investing in stocks and other securities, ship ownership, management and operation, reinsurance services, fund management services, wealth and investment management services, headquarters services to related party, treasury and finance services to related parties, aircraft financing and leasing, including engines and rotatable components, distribution of goods or materials in or from a designated zone to a client who resells such goods or materials or parts thereof or possesses or changes such goods, materials, or portions thereof for the purpose of sale or resale, logistics services, and any other ancillary activities. In the next slide, we'll be discussing excluded activities which are mentioned as per Ministerial Decision number 139 of 2023. These are all transactions involving natural people with the exception of selected transactions related to the qualifying activities, banking operations, other than insurance services, insurance activities, finance and leasing operations that are not included as qualifying operations, ownership or exploitation of immovable property other than commercial property, intellectual property ownership or exploitation, and additional activities to those specified. In the next slide, we are going to discuss the way forward. We have to check for compliance with the qualified free zone person criteria, which we have already discussed, which includes compliance with the de minimis standards. Then we have to analyze forms of activity from the standpoint of whether they are qualifying or excluded types of activity. And then in the last, we have to determine if a 0% tax rate may be applied to the income of a qualified free zone person. After assessing these all, we have to determine whether it is necessary to reorganize the company, check the benefits of changing to the general taxation system, or taking into consideration the benefits that are not accessible to qualified free zone persons. we have to outweigh these things. Thank you and have a good day.
Thank you, Mr. Duresh, for making this session so insightful and engaging. Thank you all for joining us and sharing in this interesting experience. Your presence and active participation have truly made this session valuable and impactful. We look forward to connecting with you again in our future webinars. Until then, for any further queries regarding excise, VAT, or corporation tax, kindly drop us an email or give a call. The details are mentioned on the screen.